As we sit here on this Sunday, November 30th, 2025, the markets are officially closed, giving us a crucial moment of silence to process the noise from Friday's chaotic session, where the Nvidia stock price settled at exactly $176.63. We saw a decline of approximately 1.82% by the closing bell, with the stock shedding nearly $3.28 per share from the previous open, capping off a week that has left retail and institutional investors alike scratching their heads. If you are looking at the after-hours data or checking your brokerage accounts, you will see that the last traded figure holds steady at that $176.63 mark, a number that feels precarious given the sheer volume of 121 million shares that changed hands during Friday's abbreviated trading session. The intraday range was tight but tense, fluctuating between a low of $175.07 and a high of $181, suggesting a battleground where bulls tried to reclaim the $180 psychological level, but ultimately failed as selling pressure mounted late in the day. This price action isn't just a random fluctuation. It is the physical manifestation of a market grappling with a new and uncomfortable narrative that challenges the supremacy of the world's most important company. Expectations right now are heavy with fear. The prevailing narrative that took hold late last week, and the reason your portfolio might look a little redder this weekend, is that the moat is finally drying up. The headlines are screaming that major customers like Meta are exploring Google's custom chips, effectively threatening Nvidia's monopoly on the data center. The expectation is that we are witnessing the beginning of the end for the semiconductor supercycle, that the peak is behind us, and that the AI bubble talk we have heard for 3 years is finally validating itself. But here is the reality, and this is where you need to pay close attention. The market is misinterpreting a diversification strategy as a replacement strategy. While the street panics over a headline about Meta talking to Google, they are ignoring the hard data from the Q3 fiscal 2026 earnings report released just days ago, which showed record revenue of $57 billion, up 62% year over year. The reality is not that demand is shrinking, but that the entire infrastructure of the planet is being rewritten in code, and Nvidia is still the only company shipping the pens. The sell-off we saw on Friday is a disconnect between sentiment and solvency, creating one of the most interesting setups we have seen in 2025. Let's strip away the noise and look at the tape from Friday. That move down to $176.63 wasn't a structural collapse. It was a liquidity event driven by macro fears and sector rotation. When you analyze the price action on your Interactive Brokers trading screen or your Fidelity mobile app, you will notice that the selling volume accelerated in the final hour of trading. This indicates that traders were unwilling to hold risk over the weekend, largely due to the uncertainty surrounding the semiconductor sector's relationship with big tech capital expenditure. We are seeing a classic shoot first, ask questions later mentality. The VIX, or volatility index, ticked up slightly, but notice how Nvidia stock held the $175 support level. This is critical. If the bearish thesis were truly dominant, we would have seen a flush below $170. Instead, we saw buyers stepping in at $175.07, absorbing the supply. This tells us that while the fast capital is exiting, the smart capital, the long-term funds, is accumulating. It is the tension between the short-term traders using Robinhood stock trading for quick flips and the long-term wealth managers building positions for the next decade. When you compare this recent volatility to Tesla stock or Apple stock, you see a divergence. Apple has been holding relatively steady, acting as a defensive fortress, while Tesla continues its own erratic dance based on robotaxi news. Nvidia, however, is being treated as a proxy for the entire global economy's growth engine. The concern rattling investors is the report from The Information claiming Meta is in talks to buy Google's TPU chips. On the surface, this sounds bad. If Zuckerberg buys from Pitcheye, he buys less from Jensen, right? That is the linear thinking that gets retail investors hurt. The deeper analysis reveals that Meta's AI compute needs are growing so exponentially that they need everything. They need H100s, they need the new Blackwell B200s, and yes, they might need some TPUs for specific lower-level inference tasks. But for the heavy lifting, the training of Llama 5 or whatever massive model comes next, Nvidia's CUDA ecosystem remains the only viable option. The market reaction on Friday was a mispricing of this dynamic. It assumed a zero-sum game in a market that is actually expanding largely enough to accommodate multiple players while still leaving Nvidia with the lion's share. Let's talk about the institutional activity because that is what really moves the needle. If you look at the dark pool data and block trades from last week, we saw significant volume executing at the $178 level before the price slipped. This suggests that institutions were happy to buy the dip until the momentum algorithms took over and pushed the price down. When you are managing a Fidelity wealth management account or looking at Fidelity ETFs that hold massive weights of NVDA, you're not selling because of a rumor about Google TPUs. You're rebalancing. What we likely saw on Friday was a quarter-end rebalancing effect where funds that have made massive gains on Nvidia stock over the last 2 years were trimming their exposure simply to stay within their risk mandates. It is counterintuitive, but sometimes a stock goes down because it has gone up too much, and portfolio managers are forced to sell winners to buy losers. This mechanical selling creates the red candles you see, but it has nothing to do with the fundamental business health of the company. Now, I want to pivot to the retail side for a moment. I know many of you watching are engaging with the market through apps like SoFi Invest or using Robinhood Investments to manage your personal capital. The sentiment on these platforms has shifted noticeably to fear. The comment sections and forums are filled with people asking if the run is over. This contrarian signal is often bullish. When the crowd on the SoFi investing app starts looking for the exit, it is usually a sign that the weak hands have folded. This flush-out is healthy. It resets the technical indicators, cools off the RSI, and builds a base for the next leg up. If you are engaging in self-investing or using Schwab Intelligent Portfolios, you have to separate your emotions from the charts. The chart says we're in a consolidation pattern within a massive secular uptrend. The emotion says the sky is falling. Trust the chart, not the feeling in your stomach. Speaking of trust, I want to hear from you. Comment below how many shares of Nvidia stock you currently hold and what your average buy-in price is. Are you holding from the pre-split days, or did you enter during this recent consolidation? It is always fascinating to see where the community stands, so drop that in the comments. Let's get back to the fundamentals, because the Q3 fiscal 2026 report was a masterclass in execution. Nvidia reported $57 billion in revenue. Just pause and think about that number. A few years ago, that was their revenue for several years combined. Now, it is a single quarter. The data center segment alone brought in $51.2 billion. This is the engine. The gross margin stood at 73.6%. There were fears that margins would compress as they ramped up production of the new Blackwell chips, but they held firm. This demonstrates pricing power that is virtually unheard of in hardware. Usually when you make a physical product, your margins get squeezed by competitors. Nvidia, however, sells a system, not just a chip. They sell the hardware, the networking via Mellonix, and the software, CUDA. This integration creates a lock-in effect that is incredibly difficult to break. So when you hear about Amazon or Google making their own chips, remember that they still have to run the software. Rewriting the entire software stack to move away from CUDA is a nightmare that most companies, even the tech giants, are hesitant to fully commit to. We also need to address the Blackwell architecture. This is the catalyst for 2026. The B200 chips are now in full production. Jensen Huang, the CEO, stated that demand for Blackwell is off the charts. We're talking about a chip that offers a massive leap in performance and energy efficiency compared to the Hopper generation. The energy piece is critical. As we run into power constraints globally, where data centers are literally consuming the entire output of power plants, efficiency becomes the most valuable metric. Blackwell is designed to do more work per watt. This means that for a company like Microsoft or xAI, buying Blackwell isn't just about speed. It's about being able to fit more compute into their existing power envelope. This is why the order book is full for the next 12 months. The idea that demand is falling off a cliff is simply not supported by the supply chain checks. TSMC is running its 4nm lines at capacity specifically for Nvidia. If demand were softening, we would see order cuts at the foundry level. We are seeing the opposite. We are seeing frantic attempts to secure more capacity. Let's